All right. Good afternoon, traders. Again, some of you, for the first time, and if so, welcome out to the Tradespoon Active Investor Workshop Series. A number of you were just with me in the trading room. Glad to have you. Glad you decided to come back. Dennis, still a terrific Tuesday. Thank you. Good to see you. Hello, Jerry. Glad you could make it. My name is Scott Beck. I'm the head trading coach here at Tradespoon, and I will be your host. I'm a little sad to say that today will be our last active investor for a little while. Due to market conditions, the attendance has been a little lighter. We're going to take a little summer break and come back a little bit later on. There's plenty of recordings for you to catch up on if you need to. But we'll enjoy this one. This is a topic that is near and dear to my heart. Today we'll be talking about hedging. Hedging. If you have ever gone through, if you search, I don't know where it is now, but if you search through the Active Investor Workshop recordings, there's actually a couple in there that relate to a trading plan and developing a trading plan outline, something that I highly recommend you do. And in that trading plan, you will see section 4 is risk management. And in risk management, you should define things like how much risk you take per trade risk, how much risk does your portfolio have at any given time, portfolio heat, how do you adjust those things according to market conditions, how do you determine how many trades at any given time, right? All those normal things we think of when we think of risk. But there's another piece to the risk management plan. And the last piece, and this is the one that, as I have worked with thousands of traders over the last 15 plus years, this is where 29 out of 30 times, 49 out of 50 maybe, it's missing. And that is a hedging component to your risk management. If you're bullish, and all of a sudden the market starts to show signs, it's not like you're just going to stop and reverse overnight. It's not going to happen. So when the market looks like it's showing signs of potential, drops, consolidations, escalation of fear is you'll see, I'll show you, that's the signal that I tend to rely on. I base my hedging signals on the VIX because the VIX is a measurement of institutional hedging. We'll talk about that. But this is such a critical part of your risk management plan. This is what's going to ease things around market shifts where you're in a bull market, everything's great, and all of a sudden, boom, boom, you give it back, and you're like, oh, what happened? I work with plenty of traders who make money. Their biggest problem is, can they keep it? Can you keep it when things get hard? Can you make sure that you made good money when the conditions were good, and then you transitioned well, stayed nimble, didn't lose too much, still made a little until conditions regained prior strength? That's what we're talking about today. I'm glad you could join me. I have been trading for over 20 years. I have been teaching for closer to 18 years now. I'm going to very specifically, this is the last time you'll get to hear these for a while because I won't do them, but remind you that options, trading in particular, or trading in general, options in particular, can involve substantial risk and may not be suitable for all investors. Please read characteristics and risks of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team of Tradespoon may have a financial interest in the securities presented on the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and a consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA and SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay. Hedging. Let's get straight to it, because I believe, I'm of the opinion. Now, what tools do you have? Number one, always, always, always the model. One of the things that we do. So when you think about hedging, what is a hedge? A hedge is a beautiful bush outside of your. A hedge is an insurance. It's protection. It's a trade counter to the primary direction of the market that protects against market decline. That's a hedge, right? What kinds of hedges are there? The easiest one that people tend to use is simply buying long put options. But you could certainly short the market, short a stock. That would provide you with a downside trade, a trade that makes money if the market declines, is a hedge. Now, it's only a hedge. Some of you out there may have no trades on right now. You might be flat, or you might have one bullish trade and one bearish trade, in which case you're balanced. If you're balanced, you don't need a hedge. You're balanced. If you're neutral right now, meaning you don't have anything on, and you were to put on a quote unquote hedge, it's not a hedge. You have nothing to hedge. A hedge is protecting something. For example, car insurance is a hedge on your car. You don't need car insurance if you don't have a car, right? You don't need car insurance if you have a bicycle. You need car insurance if you have a car. So you only need a hedge if you have bullishness in your portfolio. Right? That's the first consideration when it comes to a hedge is, what are we doing? We're trading something to the downside that profits to the downside to offset, right? To offset what you might be losing if things start to go the wrong way. So if you had nothing on right now and you put on a bearish trade, you are speculative bearishly. You're not hedging. You have nothing to hedge. You're speculating to the downside. So we talked about it even today, and I probably should have illustrated that point, because right now you're probably not hedging much in your trading account because you probably don't have a lot of bullish trades. Early on, back in January, February, March, when things were first starting to, weaken, we started to see signs of the market not looking so good. That is the time when you hedge, is when you're putting on a protection before the market drops, which gives you more ability to manage your bullish trades as the market's dropping, right? That's the biggest thing I want you to think about. So, okay, what is going to make you think the market might be dropping? So I have 3 core tools that I use. My favorite tool is my magic 8 ball. I will sometimes ask the magic 8 ball. And if the magic 8 ball gives me some kind of warning, I'll hedge it, right? I'll hedge it. That's first. If anyone ever needs to ask, I can ask it a question. It's right here on my desk all the time. Number 1. Number 2, the model. Now, if that's assuming you are a Tradespoon member. Some of you may be here just to evaluate what it is we do, how we do it, why we do it, what tools we use. Well, this is one of our core tools. If I bring up SPY, you can kind of see that going back here in late April, we started to get some forecasts of downward price action. That's when you want to hedge. Right now, the prediction is actually showing some stability, that we're going to hold and go sideways. I'm not hedging sideways. Remember that when you buy an option, so there's different ways to hedge. You can buy a long put, right? That means you have negative delta, but you also have negative theta. You're losing money from time decay. And right now, one of the problems is if you buy your hedges late, the longer you wait, the more you pay if you're doing puts. If you just short stock, well, you don't get leverage. So you're not going to get a lot of protection if you know what I mean. Lever. That's the great thing about buying puts is I can buy them out of the money cheap. And if the market starts to fall, they start to inflate and I start making money faster so that it really starts to offset what I might have lost as I was cleaning up my bullish positions. If you short a stock, you don't get that. You don't get that leverage. You could also do like a bearish spread, a bear call spread, a bear put spread, a down weighted calendar spread. Why would I want to do a down weighted calendar spread, meaning the calendar spread placed well below me? Why? Because if I expect the market to drop, I also expect volatility to rise. So in order to maximize what I'm doing to the downside, I want to make sure that I'm delta negative. What's delta negative mean? It means you make money to the downside. Long puts, delta negative. Shorting stock, delta negative. Bear call, bear put spreads, delta negative. Any spread built, any neutral spread built below you, you could do a butterfly or a calendar. They're both delta negative if you build it below the current price. But a butterfly is a Vega negative trade, which means it does better as volatility is dropping. And a calendar spread is Vega positive, which means it's doing better as volatility is rising. And we expect volatility to rise in a circumstance where we're looking to hedge ourselves and protect ourselves against, right, worsening market conditions. Okay. So the tools that we use are going to be very instrumental. I want to have something that says, hey, Scott, watch out. This looks like it could be going down. The model doesn't show me that right now. It was showing me that back here. The other tool that I use is the VIX. Okay, so let's talk about the VIX. Let's go to a 6-month daily chart on the VIX. Okay, and there is, if you notice, this was actually quite a de-escalation right here. Nice where the market was recovering. It kind of bottomed out and it went up. And it gave a sign here and it gave a sign. Either one of these, this was a little early, but anywhere in this zone, that was not very straight. Okay, if I go back and I look at the SPY, that escalation zone is where I'm really not liking what the market's doing, right? You'll notice that the market got a nice little recovery. It pulled back. It was looking okay. But at that time, all bets are off. And if I hadn't already had anything on for the hedge, I would absolutely be hedging here. And you can see that from that point, around 440, we were as low as 60 points below that, and right now we're about 45. So right now we're about 10%. Markets lost 10% from that point in time. We've had hedges where we put them on, we take half off, put some back on, half off, put some back on. In your hedging, you can't just buy puts, sit on it, sit on it, sit on it, sit on it, and then all of a sudden the market goes and you're like, okay, I don't need them anymore. They did nothing for you but decay in time. Remember that if you buy puts, you're losing money in time. They didn't help you if that's the case. Eventually, we have to take profit on our hedges in order for them to be useful to us. So if you're going to hedge, you need to have a plan for when do you take profits. I will take profits on half of my trade after 5%, and the rest of it I will try to hold. So if I get 5% here, take some profits, hold on to the rest of it, and then I'll add a different one here, and I'll get 5%. And then another one here, and this one, it actually did get 5%, just barely from its high down to this low, 5%. The signals that you use, now let me go back to the VIX and I'll show you some of the things. What I'm looking for is in general, and it's most of the time going to be coming when the market's doing this, when the VIX is coming down. What does that mean? So let's talk about the VIX just for a minute. What does the VIX represent? The VIX is a formula that is being calculated based off of S&P 500 index options. So you'll see it calls it the SIBO Market Volatility Index, with the market being the S&P. So the VIX is just a formula that is looking at option prices, specifically contracts from the S&P 500. Why the S&P 500? What's important about that? That is the tool of choice for most institutions. So the greatest number of institutions that share a benchmark are those that benchmark to the S&P, meaning who are they emulating? Some institutional money benchmarks to the S&P, some to the NASDAQ, some to the Dow, some to the mid cap, some to small cap, some to certain sectors. But the broadest range is S&P 500. That's the benchmark. So if a mutual fund or an institution of some kind looks at the market and they say, "Oh, I don't like the way this looks," what are they going to do? They're not going to sell stock. They have too much. They're too influential, right? The first thing they're going to do before anything else is they're going to say, "All right, let's get some protection." So what do? They buy puts, and when they buy puts, they buy a lot of puts. And when they start buying puts, the market makers from the S&P 500 floor are like, "Ooh, here we go." When someone's buying their product, what do? They raise the price of the product. That's what the VIX measures. So when the VIX is going up, it's going up because prices are going up. Why are prices going up? Because there's more buyers than sellers. What makes somebody, anybody, even institutions, more willing to buy options? Fear. That's why they call it the fear index. It's driven by fear primarily. It introduces a new market participant who is big. They have a big footprint. You can see it. So the institutions are hedging. Guess what else they're going to do? They're not going to work against themselves. So they're going to stop buying stock. They're not buying options and buying stock at the same time. So if they start hedging, and we can see the escalation, right? We talked about it here. We said, "Oh, this looks like it's escalating already." So when we see something like this, if we haven't already gotten some on, we're hedging. And if you go back, you can see a very similar thing right here. And for me, it is a higher low. We got another one here. We got another one here. So when I was showing you those additional entries, those are where I'm looking to get in, or on these higher lows. Theoretically, we got one here. So if I didn't have already enough, I would have put more on, even still. But you'll notice that back here, this preceded this. Now here we didn't get one until here, but even there, you got one. And you had at least some time to put on hedges if you didn't already have something. Now, the longer you wait, the more expensive they get. My preference is buying puts because I'm not going to be in them for very long, right? I'm not trying to stay in those puts. The puts that were put on over here are no longer on over here. There may be a remnant of this one still on, and this one is still on, but half of them have both been taken already, because you have to have a plan. If you hedge, you have to have a plan for how many you're going to buy, how you calculate the number of contracts, and how you're going to manage it so that you can't take losses as the market is dropping and then not take gains on your hedge, or your hedge was meaningless. We need to have meaningful hedges. Question came through. When put buying increases, are the market makers then forced to sell the market short as a hedge? Because I know that when too many calls are purchased, market makers are forced to buy shares. They can be, but remember that there is no, that's usually when there's equity options. Whereas remember that index options are cash settled, so they cannot be exercised early. So you don't really see that as much. They just have to hold more cash in this case, Ed. But remember what's happening. Think of it like a bookie, right? You've got a mismatched sporting event. What's everybody going to do? They're all going to bet on the easy money, the team that everybody knows is going to win. But the market makers aren't stupid. They didn't fall off the turnip truck on the way. Just like bookies aren't stupid, right? They're not giving you even money, right? If one team is heavily favored, there's going to be a spread. Oh, they've got to win by 35. You're like, whoa, 35. Well, now I'm not so sure. Or I might have to pay $10, and if I'm right, I make $1. Whereas if I bet on the other team, I only bet $1, and if I'm right, I make 10. And basically what the bookie is trying to do then is make it so that everyone who bets $1 will get paid by the ones who bet 10, and everybody who bet 10 get paid by the ones who, they're trying to find that balance. And what do? They take the juice. What do the market makers do? They take the spread. Remember, they buy the bid, they sell the ask. That's the juice of the options market, right? They get that little piece. So if everybody's buying, what are they going to do? They don't want to be on the other side, so they're going to attract other people to be on the other side. How do they do that? They raise the price. If you raise the price, you attract sellers, and they're like, oh, I didn't get enough. Raise the price, attract sellers until they find that balance. And they're just constantly raising and lowering prices, trying to find balance. And they have all the way until expiration, because these are European style options. They cannot be exercised until expiration day. Now, if it was American style equity options, then you're going to see where they have to maintain an inventory of stock or not, things like that. So Teresa said, I know too much about bookies. Of course. So that is what gives us this analysis. If there is an imbalance in the VIX, in the S&P 500 index options, it is because the institutions are coming in, and they cannot hide it. They will hide much of what they do, but they cannot hide this. That's what makes it a pure and internet research, right? A pure and honest evaluation. It gives us reliable information, right? So that's why I'm really paying very close attention to escalations, higher lows, and broadening patterns versus de-escalations, lower highs, right? Lower highs that might indicate de-escalation, because that is going to have a very direct impact on if and when I'm hedging, if and when I'm alleviating hedges and starting to trade more bullishly, right? So right now, where does that put us? We're in a quagmire, because it is, right, still expanding overall, but it's also diminishing. We've got a little bit of a symmetrical triangle, just this consolidation. It's making it hard to read, right? I mean, such a great indicator, so reliable, but right now it, like many other things, is choppy. It is choppy. It's back and forth. It's tough to read. So am I maintaining some hedge? Yes. Why? Because the VIX is in the 30s, or very close to it. But if this were to accelerate up out, and I didn't have already a negative delta bias in my portfolio, meaning my portfolio makes more money when the market drops, then I would look to add additional negative delta. Right now, however, it's hard to just buy. You can't just go buy options. I'm just going to buy some puts. They're expensive. You can't just, I'll buy some puts then. I'll probably look at like a bear put spread where I'm able to buy and sell. So hedging can be spread trading as well. And I will buy a put and sell a put to alleviate the time decay, alleviate the Vega and just bring additional negative delta into the equation. Now you're hearing me, and some of you are probably like, what the hell are you talking about? What the hell are you talking about when it comes to negative deltas and positive Vegas and blah, blah, blah? Again, now that we're taking a little break, if you go into the recorded archives of the Active Investor Workshop series and you scan through, there's some good ones. And another one of the good ones are option Greeks. If you're going to trade options, you got to speak the Greeks. You got to understand what I mean when I say delta positive, delta negative. What I mean if I say theta positive or theta negative, Vega positive, Vega negative, because we are assessing the markets according to price, time, and volatility, which is what delta, theta, and Vega help me understand how a trade will behave as one of those three variables starts to change. And that's what we mean here. So what are we expecting? We're expecting market to drop, volatility to rise, right? So you might say, well, why don't you just buy a put? Because if the volatility rises, it'll help you. The reason I don't just buy a put because I'm pretty exposed that if the market goes against me and the market recovers and it makes a big hard move up, then the volatility is likely to make a big hard move down, and that is going to cause additional and unexpected losses on my puts. So if I can protect against that with a Vega neutral trade, right, with a spread, the spread actually might be slightly Vega negative, which means it's a little slow to the way down, but it would actually protect me if the market went against me. So you can see that having this understanding of price and time and volatility is going to help you to understand what strategies make the most amount of sense. We're protecting against the market drop. And remember the old adage that stocks walk upstairs and fall out windows. When things crash, they tend to crash quickly. So when I put a hedge on, I'm expecting that it's going to start working fairly quickly. And once it starts working, it should go fast and I should be able to take at least half of the profits. Then I can decide, do I stay in, give it a little more room? And that's the kind of plan that you definitely want to have when it comes to your hedging and how, right, what you're going to do with it, how long you're going to last with it, etc. Okay, I'm going to pause. Let me know if you have any questions, right? But when you think about hedging, the first thing you have to think about is A, do you have something to hedge? This workshop would have been great 6 weeks ago or first week in January, because it was like, okay, you probably had a good amount of bullishness around those times, or some bullishness, and there was some causes for concern. So remember, you need to have some root sources that help you to see causes for concern. The VIX, the model, the magic 8-ball, whatever it is you think you need, the more tools, the better. Should I stay or should I go now? I mean, we don't really have that information, right? That's what I mean when I say this trend. Now, if it breaks to the upside like that, then I'm going to think, oh yeah, we're in a bad way, right? We're in a bad way, and this could head up into the 40s and take us down to 355 on the SPY. We could also roll over and I like it, Ed. It also could roll over, turn down, and do this and make me think one of these is coming, where all of a sudden, boom, 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 we get a nice bull run. And, just trade during day. Jerry said, yeah, actually, the higher the VIX is, the harder you're going to find your swing trading, and the more lucrative you're going to find day trading, and vice versa. If you have a VIX between 12 and 18, 20, the harder you're going to find day trading, the easier you're going to find swing trading. So I definitely do some of both. I have people I work with who do some of both. And, it's something that we want to make sure that we are aware of. Okay. Do day traders buy and sell SPY puts and calls for quick trades? Absolutely. 100%. All day long. All day long. I always hedge my hedge because the cost of the outright hedge is too expensive, right? So right now, what Ed's talking about is like a bear put spread. You buy a put, that's the hedge, but then you sell a put to help pay down the cost. I'll tell you this: if you can get your original hedge on while the VIX is like no higher than 2021, you'll actually get a pretty good bang for your buck. But once it starts to go above that, it can get worse. Please comment on the usefulness of put ratio spreads. Yeah, actually, Steve, I actually that would be a decent opportunity. The put ratio spreads. Oftentimes if I were to draw a risk profile, it would look something like, maybe you have a small credit and then you have a little bit of a dip where it's like you'll lose and then it does something like this, right? So it's like, if it goes against you, and it might also be a small debit, but that's okay, right? Where it looks something like that, and then it same kind of a thing. So if it were to go up against you like this, you would either have a small gain or a small loss or a break, right? Somewhere kind of a neutral. You do have a dead spot, and you always want to make sure you're aware of where that dead spot is. I've definitely gotten bit by my dead spots before. And then if the market does turn into a free fall or a drop, it gives you this potential. So, it's fairly mitigated risk. I like that. I should have brought that up. I like that you brought that up, Steve. Well done. So yeah, I would say a ratio put spread is a viable potential hedging strategy without a doubt. So again, right now it's hard. It's hard because we're already elevated. We've already had multiple opportunities to try to think about putting things on. This is already in elevated levels up here. Now we're trying to see if it's going to stay or if it's going to, come down and start getting bullish again, for all we know. So there you go. Great questions, great comments. I love the discussion. Right? What are the things you have to decide? How much risk are you willing to put on your hedges? I will do sometimes one trade. So if my risk model is 6 to 8% heat with 1% risk per trade, and I add a put or I add a hedge, it's going to be 1%. I'm going to basically get that put. I'm going to look at an area where I might be wrong and try to contain the loss to 1%. If I have stronger signals, I might go 2% and get more protection. Right? If I have both the model and the VIX saying, whoa, then I might be like, oh, you know what? I'm going to put 2% on. Or if I have more to hedge, that's the problem with this. There's no just like A plus B equals I'm hedged formula. It's very dependent on A, what you have as an underlying portfolio, B, how strong of a signal and how much protection do you think you need, C, for how long, D, is it raining outside? All of this stuff matters, and you got to take it into account. What's the humidity level? Okay, you don't have to worry about the humidity level. I was just joking about that one. Amazon. Amazon for just a potential trade or a hedge, or I think Amazon is kind of iffy, but I think it'll be interesting to see what happens with Amazon and Google the closer we get to those 20-to-1 spreads, right? Those will be pretty interesting to see how they play out. That's kind of the gist of what we're talking about today. And that is, what tools will you use to, it shouldn't be a question of do you hedge or not. Everybody should hedge. Everybody should hedge. Now, I've seen Vlad use VIX options. For me personally, I use the VIX as part of the signal, but I use the SPY as my trade mechanism because I love how liquid the options are. Right? The liquidity, the tight spreads, the ability to get in and out without paying too much. Super important. The VIX options are not nearly as efficient as SPY options. So if you're thinking to yourself, it's a put call. It's a ratio put spread. Cecil, ratio put spread. Yes. Steve said I have found the best hedge to be a broken wing butterfly, 8 or 10 to 1, 10-point wide, sell at 5. If it overshoots, still make money. Yeah, I would say if you were doing a broken wing butterfly, you should look at maybe a bearish diagonal spread where it is influenced to the downside, because a diagonal spread and a broken wing butterfly are very similar, much the way that a calendar and a butterfly are similar, where they have, components of the neutral strategy, but they also have components of a directional strategy, with the difference in that case being Vega. A broken wing butterfly is most, if not all the time, going to be a Vega negative trade, so that as the volatility is rising, what looked like an 8 or 10 to 1 when you first put it on is going to slow down. That the volatility rising is going to slow down the way that butterfly produces. Whereas a diagonal spread, can I give an example? It's going to be hard to give an example because they're fairly complex strategies to kind of set up and have them look the way they're supposed to, and B, we're already in an implied volatility area that's swole. So our assumption in this scenario is volatility is lower than it is now, and you're expecting volatility to rise. If you're not expecting it to rise, then yeah, that makes a lot of sense. But if you're starting off with the VIX at 18 to 20, and you're thinking it might get to 30 to 35, calendar and diagonals will have a positive Vega, and still give you the ability to build what you're talking about, which is a nice, easy structure to the downside. Anyway, something to look at. But you can see there are a number of different tools. I can short stock. There's no leverage. There's no time decay. There's no volatility, but there's no leverage. So it gives you some hedge, but not much. And it has some advantages. I can simply buy puts. Well, if I can buy those puts when they're cheap, when the VIX is low, beautiful. I mean, I can tell you that some of my absolute best trades are hedges that worked. And, after catching 5%, I caught another 10 or 15, and they just, it's uncanny when price goes the right way and volatility goes the right way, how much they can pump up the value of some puts. Just phenomenal. You can do a call credit spread or a call so you can do a bear call credit, or you can do a bear put, a put debit. Either one of those are bearish and would provide you with downside direction and mitigate price and time, right? Maybe even get time in your favor to some extent. So what I would say to everybody here is spend some time and start developing your hedge strategy. Exactly what we talked about. What signals will you use in what combination to say, here's when I'm going to put a hedge on? What trade strategies will you use to put the trade on? How will you determine your risk level and therefore your position size? And then how will you manage those trades? It's not just like, oh, I bought some puts and I'm hedged. That is how some people do it, but they never actually get out, and they just write them down, write them back up, and never actually make any money on their hedge. So their hedge does no good. So we need to have very specific plans for how we're going to implement and put all of this into place. Where does hedging belong in your plan, in your risk management plan? If you trade more technology, you can certainly use the Qs for your hedging. I tend to use SPY because I like the broad-based nature of it. I will use different strategies at different times. There are some creative ones like broken wing butterflies, like put ratio back spreads or put ratio spreads that allow you to create structures that provide potential for profit to the downside and mitigate the effects if it doesn't go the right way, if it takes too long. Um, there's no wrong way to hedge, right? There's absolutely no wrong way to hedge. It's just something that we should be doing. Comment came in, Ed said, I like your concept of harvesting the hedge after 5%. Yeah, I found 5 tends to be like, because here's the thing, right now we've seen 10 and 15 and 20%, but go back from 2009 until like 2020. And there were times where it would start to go and it's like, if you don't harvest at 5 and maybe even a little more at 10, and then try to let the rest of it run, and maybe add some more at 5 and at 10, where you're just kind of managing multiple positions, then it's very difficult to actually book gains from the hedging and then offset the losses that you incurred when the market fell. So again, I am a huge fan of hedging. I think that there are any number of ways. Cecil, I hate to put you off, but with it's almost like its own. He's asking what a put ratio back spread is. I want you just to Google that term, put ratio back spread. It's basically where you're selling one option, right? You sell a put that's closer to the money, and you use the proceeds to buy 2 or maybe even 3 puts that are out of the money. So your initial investment is minimal, possibly a credit, possibly a small debit. But your assumption is that if it goes far enough, the 2 puts that you bought will outpace the one you sold and give you downside potential. The dead spot will be between the puts that you bought and the puts that you sold. If it stays there, if it sits in the dead spot, you will lose money, right? But it can be a cheap or low risk strategy to give you some extra downside protection. It's definitely one I would suggest. So look into some hedge strategies that we talked about: shorting, buying puts, bearish vertical spreads, bear call, bear put, a bearishly set calendar or a diagonal spread, or a broken wing butterfly, right? I mean, there's a lot of different ways, and everybody has an opinion as to which one is the best. There's no mathematical like, oh, I can prove to you that this one is better. It just depends on the scenarios and depends on how you manage the trades. So have rules for position size, have rules for exits, have rules for adding new or additional hedges. But I would say that the more time, if you haven't learned that from this most recent increased volatility in the market, you should, and you want to implement that and have that plan so that the next time the market turns into a good bull run and you're bullish and you're making money and you're like, hey, everything's great, you start thinking, but what if I see this? How am I going to handle it? What am I going to do? I think you'll be glad you did. So, okay. That is gonna do it for me. I'm gonna open it up for questions real quickly. If by 5%, do you mean if 5% gain on the hedge or 5% down on the market? 5% down on the market on the S&P. Yeah, 5% down on the market. Sorry, I almost missed that one. Thank you. So anyways, yeah. Wouldn't you like to be a hedger too? You do. Hedge. Make that part of your risk management. Be thinking about, some different signals and things that can help you to know when to put it on, etc. Okay, well, for those of you who just only come to these active investors every other week, I apologize that I won't get to see you for a little while. But like I said, just as the numbers have been down due to market conditions, we're just going to take a little break here during the summer, maybe pick back up later in the summer or in the fall. Those of you who are in the trading rooms, I will see you soon. If you're thinking about it and think, yeah, I want to do this, you do. Sign up, join us, come on in. We do good things. Thank you, Jerry. I appreciate that. I appreciate that compliment. I hope you have a wonderful day. I hope everybody has a great day. And as always, happy trading.